Welcome to Destination Business Freedom, hosted by Pat Mancuso. Join us as we explore success strategies and hacks from leading entrepreneurs, helping you bridge the gap between financial success and personal freedom. Your journey starts here.
Pat Mancuso here. I'm the host of the Destination Business Freedom podcast, and we are excited that you're here. I interview thought leaders, entrepreneurs, and business owners who have either exited their business or are on that journey. And I also interview business owners who are helping people on that journey. My goal is to help small to medium-sized business owners close the gap between their finances and their freedom by utilizing tools and advisors so they can ultimately define and arrive at their destination, whatever that looks like. Today, I'm going to introduce you to an amazing guest here in just a second, but I want to introduce our sponsor for today. This episode is brought to you by the Mancuso Consulting Group, which uses its proprietary Mancuso method process to help entrepreneurs and business owners dedicated to closing that gap between their finances and their freedom. When you go to www.themancuso-method.com and take our short assessment, you will receive a powerful report with a personalized roadmap to your destination. I will meet with you and review that roadmap and offer valuable insights based upon my over 30,000 hours of experience in working with business owners. I believe in the power of the process so much that I will guarantee to add at least $10,000 of value to you in that 30-minute call, or I'll write you a check for $500 on the spot, no questions asked. If you're ready to move forward towards your finances and away from your frustrations, go to www.themancuso-method.com to take our assessment and schedule your call with me. Well, I am very excited, ladies and gentlemen, today about our guest. I'm going to introduce you to just a second to someone who, if you are in the journey of exiting, you need to talk to him before you get too far. If you haven't even thought about it yet, you may need to talk to him before you get too far, because one of the things I've learned in my journey is that you have to start the process of even considering the exit long before somebody taps you on the shoulder and brings you an amazing offer to the table. So I want to introduce you to Adam Webb. Adam has over a decade of experience with Quazar in representing privately held businesses in the lower middle market and guiding them through the sale and acquisition process. Adam's primary focus is leading the sale acquisition process with clients, and he also focuses extensively on managing prospect relationships and general business development. Prior to joining Quazar, Adam was part of the risk management consulting group of RSM in Minneapolis. Before that time with RSM, Adam was an internal auditor at Cedar Fair LP. Adam, we'll kind of push that aside on that internal auditor thing. I did a great experience. No, I'm just kidding. Adam graduated summa cum laude from the Carlson School of Management at the University of Minnesota in our backyard, with a Bachelor of Science and Business degree majoring in finances. No wonder why you are doing what you're doing today. I was introduced to Adam being a part of a panel that Adam and I were on through Ryan Tansom, so I want to give a shout out to Ryan and that invitation that we both received for that. So I am excited for you today to Adam share your experiences. So welcome to the show.
Yeah, thanks for having me on, Pat. I'm very excited for this discussion, and it's always fun to kind of talk about what we do at Quazar and how we help people. And I'm very much looking forward to diving in.
Well, I mean, what an exciting time, right? I mean, I don't have to share with you the demographics of business owners right now, baby boomers who own businesses and who are going to be exiting those businesses over the next 10 to 15 years. And so it's such an exciting time. But before we jump into that, Adam, I want to just ask, because, people sometimes, hear a term or a phrase and they've got a predetermined idea what that is. What the heck is an investment banker?
That is a great question. I'm really glad you asked, Pat, because I think it's a confusing term. And I think it's confusing because it's a broad term that can mean a lot of things, right? So right. I think a lot of the people listening to this are probably familiar with the term business broker. Right. And it's kind of self-defined. It's a broker of businesses, right? To match buyer and seller. Well, what we do at Quazar is very similar. The way we go about it might look a little different than a business broker, but ultimately we're helping people buy and sell companies. Why we say investment banking, it just kind of the market we serve is a little bit upmarket. So we're working with a little bit larger businesses than a business broker. Yeah. But the term investment banking it can mean a lot of things. I mean, it's a blanket term for a financial services company that may offer they may offer equity raises, they may offer debt placement, they may offer IPO services, they may offer merger and acquisition advisory. And at Quazar, we just specialize in a really kind of narrow band within investment banking, and that is merger and acquisition advisory. And we offer what we call both sell side and buy side advisory. So we will represent sellers of businesses as well as businesses looking to grow through acquisition. And as you mentioned in your incredible introduction, I don't think I've ever got such a great introduction, that we serve the lower middle market. So generally, we're working with businesses with $10 to $100 million of revenue. That can vary a little bit depending on industry, and typically privately held businesses. So oftentimes we're working with founder-owned businesses or second or third gen businesses. And our typical client wants to do something else, be it retirement or a different adventure in life, and they don't quite know how to monetize this this great asset that they have. So we help with that process.
So I want to start with, let's just lay some kind of market conditions right now. Like if I'm a business owner and let's say I haven't even considered selling, or I'm a business owner that's thinking about selling. I mean, talk about the market a little bit right now.
Yeah, it's been an interesting ride, kind of the last 5 years. I'll maybe give a brief overview of what we've seen over the last few years, and then get into what we're seeing right now. So,
that'd be great.
Let's say right before COVID, 2019, getting into 2020, it was a good market. There's a lot of deal activity. Valuations are at or near all-time highs. Again, kind of depending on individual business situation, the industry it's in. And then COVID hit, let's call it March 2020, and all deal activity shut down. I mean, I think at the time we were working on 6 transactions, and over the course of a week, everything paused. In fact, I remember I walked into my partner, Nicole, I walked into her office and I said, Nicole, I don't have anything to do. And I never said that before. I'm like, I don't think I have anything to do. And it was a pretty scary time. I mean, not just for our business, for most business owners, and for kind of our country and the world and our economy. No one really knew it was going to happen. And fortunately, what ended up happening was the Fed took very aggressive actions to keep the economy flowing and liquidity flowing in the economy. And some of those actions were aggressively lowering interest rates. They also did a bunch of things in the background which encouraged banks to lend. So low interest rates, banks are cash rich, and they want to lend. And what that led to was, call it in maybe June or July of 2020, so only a few months after COVID really shut things down, deal activity roared back. I mean, we saw unprecedented interest from buyers. Valuations were silly. Buyers were willing to close over kind of major issues just to get deals done. And I mean, it was a crazy time. And we ended up having a record year in 2020, and that spilled over into 2021, and the good times were flowing. And then 2022, things started to slow down a little bit, but not a lot, I'd say. 2023, when the Fed really said, we got this big inflation problem now, we need to raise interest rates. And what that does in our market, when the cost of borrowing goes up, the amount a buyer can pay for a business in order to achieve a desired return goes down. So, low interest rates, better for M&A activity, high interest rates, worse for M&A activity. And we really saw things start to slow down significantly in 2023. So 2023, for us and for kind of the market more broadly, my colleagues in investment banking and in the business broker world, it was a harder year. It was harder to get deals done. The thing I just mentioned, where buyers were willing to close over issues, it swung completely the other way. Like, I'll give you an example. When we're under letter of intent, so when we're under an offer for a deal, but we haven't yet closed on the deal, typically every month we're giving the buyer updates on how the business is doing. So we put together a package of financials, we send it to the buyer. In 2021, but I don't even think buyers looked at them. They didn't even care. In 2023, any any kind of friction or bad news in the financials, buyers were having calls. We were having calls with their diligence providers. We had to explain, why did revenue drop 1.8% month over month? And buyers were just really nervous because that cost of capital is much higher, and the debt levels they could get for an acquisition were significantly lower, right? So it was kind of a double whammy. Now, we've started to see things loosen up over the last couple of months as the Fed signaled interest rate cuts, and we saw that yesterday with a 50 basis point cut. And that's really spurred more buyer interest. It's spurred private equity that owns businesses to really finally, I think in general, they think it's finally the time to sell businesses, and that helps with overall activity. So the state of the market is better than it was. I'd say it's pretty good. It's not quite what we saw in 2021, but again, it really is deal dependent, right? So there's certain industries which we're seeing, blowout valuations and record valuations. Other industries are more challenged right now. So that's a very kind of individualized answer, but overall, the market's in a pretty good spot.
So let me ask you a question in terms of, because you're talking, you talk with a lot of businesses, you're part of a lot of groups, when you look at the economy, and I mean, I read a lot and I hear a lot, and I talk with business owners on a, daily basis as well. And I think you hit it. In some markets, the economy is really good. And in other markets, it's really challenged. So just give me your just real quick thoughts on overall perspective on the economy and where we're going. Because I have some thoughts, but I'm curious what your thoughts are.
Yeah, there's a lot to unpack there. I'll get into both kind of a perspective from size as well as a perspective by industry. So what we've seen over the last few years is, and if you read like the Wall Street Journal, you'll see large investment banks have done layoffs and their deal activity is way down. And that's because those large deals are much more leverage or debt driven than smaller transactions. So like, let's say a company is going to trade. Banks are, larger deals are generally seen as less risky to buy, right? So if you take the extreme of like Microsoft or Google or any of these, Johnson & Johnson, any of these big publicly traded companies, those are generally seen by the market as the risk of those significantly declining in value is much less than the risk of a small business significantly declining in value. And there's reasons for that, right? If you have a small business and you lose just a few key people or a few key customers or a few key vendors, that can significantly impact your business. Whereas if you're huge and you're much more diversified on that front, the risk is just more spread out, right? So banks are willing to lend more to buyers of large, more stable businesses. And it's a continuum, right? So on one side, you have those massive publicly traded companies. On the other side, you have a smoothie stand in a mall, right? Like as small as a business as they come, and then kind of everything in between. So what happened when debt became more expensive and harder to come by was those large deals, they're putting more debt, which we measure as turns of EBITDA. So, if you take earnings before taxes, depreciation, amortization, and I think that's the whole EBITDA, and make adjustments, and then take the debt a buyer is going to put into the deal as a multiple of EBITDA. On large transactions, it's much, much more than on smaller transactions.
Yeah.
So on those smaller transactions, the debt levels that have been kind of normal have generally still been available. So, putting 2 times EBITDA in debt on a business, that's been available, over the last few years. Okay. Putting 8 times EBITDA debt on a business has not been available.
Okay.
So, kind of those big investment banks have really been hit. And then you have the middle market banks have been impacted, but not as much as the bulge bracket. And then you have us sitting in the lower middle market. We've been impacted, but not significantly. And then you have business brokers, down market of us, who have really not been impacted much at all, right? Banks are continuing to do SBA deals and they're very comfortable with those. So that's how I would answer your question.
This. Oh, no, it makes perfect sense. It makes perfect sense. So I want to kind of shift the conversation a little bit. And, our goal on our podcast and, the work that we do is, and Ryan actually describes this in such a great way. It's that most business owners, small to medium, let's say, and that might be your lower end of your middle market. It might even be middle, the middle part of your middle market. They get into business. They started, maybe they were the, landscaper with the lawnmower in the back of the truck, and now they have 100 employees and, they're doing 10, 15, 20 million a year. But in many cases, they've never looked at the exit. They've never even, in a lot of aspects, even kind of thought about it, because they're either still in the business day to day as an owner operator, or they're so far removed from the business on a day to day that they just, they haven't really thought about it. So let's take that business owner, your market, the business owner that comes to you. Let's start with first, typically, how do they come to you? I mean, do they come to you earlier than they should, later than they should? Let's talk about how they come to you.
Yeah, great question. Generally later than is ideal, right? So, and I get it, right? Like, they are extremely busy people. They're usually active within their business. So they're heads down every day, kind of managing the business and taking care of everything that falls on the shoulders of a business owner. I'm a business owner. I get it. It's difficult to step out of that and take the time to work on the business or think about the business. So I understand why, but yeah, it's typically they want to retire pretty soon, within the next year or two, and they want to sell the business and they come to us. They're almost always referred to us. So, we're in kind of a referral business. So think other people with clients like attorneys or accountants or financial advisors, consultants will refer us, business owners. And then, so that's usually how they get to us. And, ideally we'd start having conversations well in advance of an exit, just in case, the value isn't what they need it to be to live the life they want to live. Then they have some time to build that value. Sometimes we don't have that luxury. We've had clients with significant health issues where their hand was kind of forced to sell, and we can usually make it work, right? We'll work with what we have, but in an ideal situation, we're talking to someone maybe 5 years in advance of a transaction.
And the reason I wanted to pull that out of you, and I kind of anticipated your answer on that, is I was reading that book. In fact, I just finished it. It's an amazing book, and the title of it is Building Your Wealth Through Tax. And basically, and I don't even have the title right because I just got done reading it, but what caught me in the book is that we think as business owners, and this really struck me, like, and I'd be interested in your thoughts on it. We think as business owners that when we retire, we're going to need less income to retire. And what struck me from this conversation as it related to wealth and tax is that's actually flawed, because as a business owner, I had certain benefits or incentives to be building that business along the way. And now those go away, which means my income's not going to go down if I still want to live the lifestyle in some aspects that I'm living right now. You see where I'm going with that?
Really well said. Yeah, I agree. That can be a faulty assumption. Also, folks, when they're super active in their business and they're working every day, they may be spending less money on other things than they would in retirement, right? So it's kind of that, they lose the tax shelter of a business, and then they also, just have more time. And with more time, for some people, means more spending.
Well, that's the whole idea, right? Of building a business, and then retiring, if you may, is so that you could maybe do some of those other things and travel. And in the premises, those expenses aren't going to go down 5 to 10 years from now. So it just, it's a super passionate topic for me, because if I don't define what that destination is with, the help of advisors like you and, all the people involved in the transaction, I'm likely not going to experience what I want to experience. And by the time that I'm ready to retire, it's too late because I've lost all those years of opportunity.
Totally agree. Yeah.
I think it was an amazing book. We'll post it at in the website notes. I'll make sure that we get that to the
fantastic.
Yeah, it just like there were so many things in the book that struck me. Trust me, there were so many things.
Yeah,
Go ahead.
Sorry.
No, go ahead.
Oh, I was just gonna say, yeah, I totally agree. Kind of like where we get people come to us, like oftentimes they don't know what their company is worth.
Right.
And we're working with business owners with companies worth 20, 30, 40 million dollars, right? I mean, these are significant assets. And again, I understand why, but if you don't know what the business is worth, you can't kind of plan for the life you want. Because, working with someone like you can help with that planning process, but you got to plug in the value of this huge asset and timing and all that. So yeah, people are much better served by starting early.
Okay, so I'm gonna have a little fun in the middle. Do people come to you where their values are more or less than what they think they're worth?
You probably know the answer. I'd say 95% of the time the value is less than they're either thinking or hoping, right? I mean, they're usually understanding because the way we go about our process is we put a lot of thought in the front end on how we're coming up with that feedback around value. We use several methodologies and explain all the details. So we can explain the whys, but yeah, I usually end that conversation with, how does this compare with what you're thinking? And the answer is usually, I was hoping it was worth a little bit.
Okay, true or false? They think 20 million is what they're going to take out at closing.
Yeah, that's a great question.
What? They're not getting the whole 20 million?
Yeah, I mean, I think people generally understand there's taxes and there's transaction fees, right? They have to pay us, and there's usually some other diligence providers involved, like lawyers and maybe a quality of earnings firm. And then you have to pay taxes. And then sometimes, I mean, we're generally pushing for as much cash at close as possible. And sometimes there's structure involved in the transaction. So when you stack all that up, I mean, someone may walk away at closing with 60% of the headline value, right?
Right.
And that can be a surprise.
So I'm just texting my my director of operations because I wanted to bring this book in, the book, because I do want to give it to you. But one of the things that you just said is that the deal, right? So when somebody, because I want you to expand on that further, when company's worth 20 million, like, true or false, the majority of the time they think they're going to get 20 million in cash at the table, and very rarely does that happen.
It's interesting. So yeah, I mean, they're not going to walk away with 20 million after tax, right? Again, there's all those transaction expenses and then tax. Outside of that, oftentimes deals have what we call structure. Right. So
go into detail a little bit on structure, because I think that's important for people to understand.
Yeah. So what structure is, it's basically anything that's not cash at close, but is still additional consideration to the seller. So structure can take different forms. Sometimes it's escrows. And in our transactions, there are typically escrows we call them indemnity escrows, and then often a working capital escrow. And that might shave, 10 to 15% off the top. And the good news is seller usually gets those back. Right. But it's not cash they get at closing. If private equity is the buyer, they often would like to see an equity roll, what we call an equody roll. And that's where
you want some of your money back for a period of time and have you stay in the business maybe for a period of time.
Exactly. It's you're going to retain some ownership in this new company. And then when we eventually sell that new company, you'll get paid out on that. And again, we've had good outcomes for our clients with equity rolls, but it is not cash at close. And there's a level of uncertainty associated with it. And then mostly down market of what we work on, but there's oftentimes seller notes in SBA finance deals. And that's where, as the seller, you're helping finance the buyer. So the buyer is going to owe you money, and they're usually making monthly payments over a period of time. And then the final form of structure is what's called an earnout. So earnouts are usually a risk sharing mechanism where, let's say, Pat, you have a business and you think it's going to the moon in 2 years. And I, as buyer, can't really see how you're getting there, right? So a good mechanism in that scenario would be an earnout where hey Pat, I'm gonna pay you a fair value for where the business is today. You're gonna get that in cash. But for this kind of growth that you're convinced is going to happen, if that does happen, we're going to put together a structure where you get paid more over time. But if it doesn't happen, you're not going to get paid more over time. So we're going to share in the risk of that future unknown. And earnouts, again, for really steady businesses, we usually don't see them. But for businesses with varied financials, coming out of COVID, there was a lot of uncertainty in certain industries with kind of what's the new level of normal, and buyer and seller sometimes we're on the same page, and earnouts can be a helpful mechanism in that scenario.
Yeah. You know, one of the things that I've learned in my journey, and again, it's like, you know, I work with businesses, but I also, you know, own businesses, is there's so many things that impact value that we don't necessarily see when we're right into it. So, you know, like we're into it day to day, that again go into that value. So just even like a customer list, like, if I've got a business and, you know, 70% of my revenue is in 2 or 3 customers, that impacts the value both positively, potentially, but then negatively if those clients go away. So here's what I've heard you say so far. Somebody should talk to you if they're thinking about selling their business earlier than later.
Correct.
They may have a difference of opinion on value, but you're going to put together an amazing process to actually give them the information that they need to come to the conclusion that you know, maybe it's not where they thought it was, but here's what it could potentially be. And then you know, the process to get to that closing is going to vary a little bit, but you're going to help them in that process. And so, where do most deals fall apart?
That's a great question. It's usually when there's an unexpected change, and that
in the due diligence, you mean?
In due diligence. So yeah, so typically if a deal falls apart, it's after we've marketed the business, we've talked to buyers, we've signed an offer in the form of a letter of intent,
right?
And at that point, the deal is very much not done. Right. So the buyer is going to do their due diligence, and depending on the type of buyer, due diligence is somewhere between painful and extremely painful. And but I mean, buyers ask for a lot of stuff, and rightfully so. They're buying this complicated asset. Businesses are complicated. They have a lot of moving pieces, and they want to verify what they think they're buying is indeed what they're buying. And if there's a finding in due diligence or a change in the business during the due diligence period, oftentimes the buyer will either walk away or more often propose a different valuation or structure.
Yeah, and so I think we shared with you before we started today. I was in San Diego the last couple of days as part of a mastermind group called the Epic Network, founded and created by Roland Frazier. And one of the things is each session they bring in an M&A attorney who's part of this group, Grant Steeple, and he talked this week about the due diligence process. And one of the things that struck me in that conversation that I don't think most sellers know or understand is that each time there's a surprise, or each time that there's information that should have been shared or wasn't shared, or maybe wasn't as clean as it needed to be, you just said it, the buyer is going to potentially reduce the value of the business, or they're going to walk away with neither of which benefits that seller. So that really struck me, like, it is to get the business in order before you actually start marketing it, because those things are going to come up. It's only a matter of time, right?
100%. Yeah, we have a saying, I think it was just used in investment banking, but go ugly early. So, like if there's skeletons, I mean, there's certain ways to
there's always skeletons, right?
Like there's skeletons and there's hair on deals, and that's almost always the case. But if you can position it correctly and have the right conversation with buyers on the front end, it's way better off than saying, I hope they never find this, because they will. I mean, due diligence it's unbelievably involved. When we ask clients after closing, what was the biggest surprise of the process? The answer is almost always how much work due diligence was. Yeah, it is involved. Buyers are going to figure things out. So certainly fix what you can. And if there's some warts left, like putting those out front is better than holding them back for due diligence.
What was the phrase again?
Go ugly early.
Ugly early. I love that. I love that. I can't wait to see how that shows up in the notes. So I wanted to just share the book, that the Tax-Free Wealth, written by Tom Wheelwright, and this book, for our listeners, and my goal is to get Tom on the podcast. It was amazing. There were so many things in here that I took away from as a business consultant, tax consultant, and as a business owner. And the thing that I love that he said was the tax law is actually there as an incentive. And you've been around a long time, Adam. I come into contact with business owners who have advisors around them who look at the tax law, tax code, tax credits, and they run from them. And what was really empowering to me about the book is it's actually the opposite. His premise is that the tax law is there as an incentive from the government to help business owners build businesses, because when they build businesses, they hire people. And when they hire people, they pay wages and they pay taxes. Now, they're going to want that money back at some point when you sell the business. But the point is that having those right advisors around is so, so important. And obviously, you guys are doing great work in what you're doing. So go ahead.
Oh, I just had a quick story, and sorry for jumping in again.
No, I love it.
On that point, so you hit the nail on the head. Having the right tax advisor is critical, and that shouldn't just be someone who takes the transaction numbers and runs them in a spreadsheet and says, "Here's your tax bill."
Right.
Like most people can do that, but at least most kind of accountants can do that.
Well, that's what the average people do, to be honest with you. After reading the book, that's what I realized.
Correct.
The average people do that.
And sometimes that's just is what it is, right? But there often are strategies to significantly reduce tax bills or defer
legally and ethically.
Ethically. I mean, there's deferred sales trusts. There's these trust mechanisms to defer taxes. We had a transaction. I like telling the story because I think it hammers home the point. We had a transaction where our client was structured as a C corporation, which means if you sell assets from C corporation, it's double taxed. So the corporation pays a tax, and then when you pull the money out of the C corporation, you have to pay tax as well.
Double tax makes a lot of sense, right?
Yeah, it's super fun. So our client's looking at this. I think the deal was like $7 million, something like that. And they're looking at this as like, I have to pay, it was like a 55% tax bill. It was over 50%. And they had an accounting firm, and they just said, yeah, that's too bad.
That's what it is.
And the buyer had an accounting firm and looked at it and said, yeah, it's too bad. And there was, I won't get into all the details, but there's different entities in the buyer group. And one of the entities had an accounting firm, and one of the partners at the accounting firm goes, you know what? This qualifies, I think, for something called personal goodwill due to the seller's personal involvement in creating this asset within the C Corp. So he goes, you should look into that. So our client looked into it, and it did. Like 80% of the transaction was allocated to personal goodwill, which was taxed at capital gains rate and avoided the double tax. And there's a bunch of accountants involved in this transaction. Only one of them kind of was aware of this thing and thought of this thing, and it's completely legitimate. And this, it has to qualify, and there's all these things you have to do, and you have to get a valuation. But this situation qualified perfectly for it. And he saved 7 figures on taxes just because that one accountant said one thing on a phone call. And I think about that a lot, like, geez, it's one of those things you almost don't know what you're missing if you don't have the right tax advisor at the table.
Well, and Tom talked about that in the book and again, he's a CPA, so this isn't an indictment on CPAs who are listening, please understand. However, what he said is that many times they're just reading the summary of a code. They're not actually understanding what the law is behind the code, what the findings are behind the code, what the challenges to the code are, what the court results to the code are. And I also found that very interesting, and it makes sense because, we've lost 400 and some thousand accountants according to a lot of estimates since COVID. and people struggle to find that great resource. And that's a passion for us as well, as aligning ourselves with the people that our business owners can actually trust as part of the process. So I love you sharing that story. And I do remember you sharing that story at the,
I love telling that
because it's a great story. I mean, that's real money.
It's like life-changing money to a lot of people, right? And it's just like, he would have just paid the tax bill and not known any difference and not with his life. Instead, he has, $2 million more to do what he wants to in retirement.
So let's shift gears a little bit without naming names. Talk about just real quick, the absolute worst transaction that you experienced and why, without giving details.
That's a great question.
One that might be painful to relive.
Oh, there's a few. Like the really painful transactions tend to be when we don't have the right advisors working with us and our clients on the transaction. So, for example, I can think of a transaction we worked on where our client had a trusted attorney that they worked with for decades, who was primarily a bankruptcy litigator, and did their general corporate work. And we got involved and strongly recommended that they continue to work with that person, just not for the transaction, right? A sale of a business commands a very specific area of legal expertise.
Right.
And there are many lawyers who only or primarily do mergers and acquisitions work. And it's important to get someone like that for the sale, because they know all the market terms and the nuances and what's market, what's not market. They understand there's usually a dance that happens between legal counsel where there's some level of back and forth, but it's not an absurd level. And there's just this nuance to it, which if you moonlight in it, you're just not going to be dialed in and be able to do a good job on behalf of your client. So back to the situation, our client decided they wanted to use the bankruptcy litigator for the transaction. So we got the LOI signed, which was painful. He had some interesting ideas, and it puts us in an awkward role. We're not attorneys. Our clients need to rely on their legal counsel's legal advice.
Right.
At the same time, we do a lot of deals and we're on all these calls, so we have a pretty good feel for what's market and what's not. So we can kind of say our 2 cents, but ultimately we're going to defer to the lawyer on the transaction, even when in my heart of hearts, I think they're wrong. So we got through the letter of intent. We got a copy of the purchase agreement, and it was a little buyer friendly, like they usually are, and we get them but it was fairly market, and it had things in there like representations and warranties, right? So if you sell your business, in the purchase agreement, which is the governing document of the transaction, you're going to have to say certain things are true, right? And that gives the buyer protection, because no matter how much diligence they do, they're never going to know what you know as a seller.
Right.
So those are always in a purchase agreement. And he struck all of them. And he just said, our client's not going to take the risk. And my position was, well, as long as everything's true, there's really no risk.
Right.
The deal fell apart because we could not convince the lawyer that certain things were typical in an M&A transaction. I was even like Googling and big law firms will often put kind of articles on their website about topics in an M&A transaction and sending those to him. And I think he got insulted, but like he wasn't doing a good job for our clients and for his clients by stubbornly taking a position which no buyer, and this buyer included, was ever going to accept. Right. So, and I've run across a few situations like that, but that's probably the most painful deal.
There was probably some skeletons in the class that he knew about, and that's why he was striking it.
It very well could have been the case.
Right? I mean, it just like even with that type of language, there's still remedy for the buyer if with the right language and an agreement. I mean, there's still some liability there, right? I mean, so that's crazy. Okay, so here's what I want to do now in the last part of our conversation here. So if you're talking, people will hear this podcast and they're thinking about selling their business. They're thinking about maybe 5 years from now. Like just talk to them about, okay, what's their next step? I mean, obviously it would be to call you. I get that part, but like 2 or 3 things that they should be doing right now before they call you.
Yeah, so there's some general advice we often give when we talk to people that far in advance. For one, kind of working yourself out of an active role within the business as much as is possible, right? But for example, if you're owning your business and you're the key point of contact for 80% of your customers, but buyers don't want to see that, right? Or like you brought up earlier, Pat, if you have 2 customers, which are 70% of your business, that's probably been great for you as a business owner. You're not going to turn down good customers. However, when it comes time to sell, it will have a valuation impact and it will likely have a structural impact too on the deal. So a buyer is probably going to want a lower value and they're probably going to want an earn-out tied to future revenue or future EBITDA or future gross profit, so that they know if those buyers go, or if those customers go away, they see a reduction in purchase price, basically. So those are, kind of a couple pieces of advice. Outside of that, lining up a transaction team, which is something I think people should do years in advance. It's free, like talking to an attorney and getting comfortable with them and making sure like you kind of have the right rapport with them and you trust them. That's free. Right? An attorney will be happy to do that. Same with a tax advisor if you don't have a good one already. Same with an investment banker or a business broker. I mean, we will spend significant time on the front end, putting together a market analysis, giving a view on value, keeping in touch with folks and making sure we're getting the timing right. It's at least our philosophy is we don't charge. Like, we want to help people and we think of it as kind of a marketing expense. We're proving somewhat our value on the front end before people have to start paying us. So, and I believe in that. So that's, those are some pieces of advice kind of generically, but if someone does talk to us on the front end and they're years away, we're usually able to give them some specific advice relative to their business on things to do and give them different, let's say we meet with someone and they need $20 million and it's only worth $10 million today. Well, how do they get to 20? Right. And outside of get more sales, right? Which isn't very good advice. So it's like, we will kind of give that level of detail on the front end and try to be a resource to people.
Yeah. And what impressed me a lot when we were on that panel together was just that approach, right? It's, you may not be a client today, you may not be a client tomorrow, but at some point you're going to sell your business. And we want to be that resource for you when you do it. And we're going to help you to get there. And that's a philosophy that doesn't exist a lot in the marketplace out there because everybody wants to do the deal today. But B, it also that, lends itself to, what you guys do in the relationship that you have and then the referral base that you have. So I just love that. Well, so if somebody wants to reach out to you, Adam, what is the best way for them to do that?
Yeah, they can either call into my office or send me an email. I'll just say my email. It's adamw@quazarinc.com. So QUAZARINC.com. Otherwise, my office number is 763-550-9000. And, our process is we generally just get a time to get together. We ask a lot of questions because our goal initially is to understand why are they talking to us? Right. What's the seller's goal? And then we want to understand their business a lot. And then we usually follow that up with some financial statement requests and dig into those and then put together we call it a market analysis and educate the seller about what we think the value looks like, the types of buyers that we think are out there, what a sale process timeline looks like, and kind of what they're in store for. Because, selling your business, it can be extremely rewarding, right? I mean, you get a big liquidity event at the end of it. It's also a lot of work. It's a lot of work. And, I'm probably not being a good salesman by saying that, but it's very true.
You're being honest.
If people think, they work 9 to 5 today and they're just going to kind of squeeze this in to their 9 to 5, that's going to be very difficult. It's going to involve kind of an extra layer of time on top of their normal commitment. So not only does the valuation need to work for their life goals, but they also need to look in the mirror and say, am I in for this? I'm ready for what's in front of me, because it's it's a process. It's a lot of work. It can be very emotional. You're going to have a lot of buyers looking at your business and saying, I'm not interested. And that can be, defeating and challenging. But there's almost always a pool of buyers that say, I am interested. And that's where the real work begins.
Yeah, no, I love it. I mean, all great advice. And, we haven't even talked about, there's many ways to exit the business, right?
Yeah.
I mean, we haven't talked about that, in ESOPs and such, where people that haven't even considered that. And I'm assuming those are things you all can help them with as well.
Yes, some no.
Yeah.
So
but you have resources if not.
Yeah, we can put them in touch. Like, we won't help people convert to an ESOP, but if the path that we think is right for them and they want to go, we can certainly put them in touch with the right folks.
Yeah. Now, you said QuazarInc.com, correct?
Yeah, inc.com. If we have another minute, I'll tell you a story on why.
Go.
So, for forever, our website was quazarcapital.com. And the reason it's not just quasar.com is because there's a band named Quazar, which weirdly enough is based out of Minneapolis, where we're based out of.
Sure.
And they own the domain. So a few years ago, we rebranded, and having the name Capital in the domain was a little confusing to people. They thought we were a bank or
yeah.
So I reached out and got a hold of the owner of QuazarInc.com or Quazar.com, excuse me, and tried to negotiate a buyout of the domain, which they're not really using anymore. And it just didn't go anywhere. So we just added INC to the end. And so if the owner of Quazar.com is listening to this, please contact me. We're still interested.
Oh my gosh. That would be a whole podcast on understanding, value and business and opportunity. And oh my gosh.
It's so true.
Oh my gosh. Well, Adam, first of all, thank you so much for spending the time. You have been a wealth of information, and I so love the approach that you guys take to the business, to a business owner. And, it just folds right into what I'm so passionate about. And that is, many business owners work their entire life. They don't walk away at the exit with what they expected, what they wanted to, or what's going to provide them that future opportunity. And so, folks like you that actually contribute to that happening are just it's just amazing. And I'm so grateful that you took the time today. And so we thank you for all the great information that you've delivered today.
Well, thank you for having me on, Pat. I really enjoyed the discussion, and thank you for doing what you do as well. I think anyone with a philosophy to educate and help business owners meet their goals, whatever those are, I just have a lot of respect for. And I think that's just the right way to do business, and that's the right way to help people.
Well, small, medium-sized business owners are what make the economy grow and go and employ so many thousands of people. And there should be a reward at the end for what they've done. So thanks again, Adam. To our listeners, thank you so much for supporting our podcast. And we appreciate any time you can share with fellow business owners or anybody who you think can benefit from the podcast. You can do that at all your favorite podcast sources. And again, if you have any interest in having a conversation with us, www.themancuso method is that free assessment for you. We'd love to connect with you. Adam, have an amazing day. It looks like it's going to get a little crazy for the weather here in Minneapolis this afternoon, so stay safe.
Thank you, Pat. You too. Thanks again for having me.
We'll talk to you soon. Take care, everybody.
Take care.
Thank you for joining Destination Business Freedom with Pat Mancuso. May the insights and strategies shared guide you towards financial prosperity and personal freedom. Continue to navigate boldly. Until next time, keep transforming challenges into achievements. Farewell, and stay the course.